ever since Christine got there. It used to be over there. I'm going to tell her. She likes that stuff.
So I know I've been through.
I think we're going to get started. Good. Welcome, everybody. Let's get started. The faster we can assemble everybody, the faster we can get into the questions. I want to welcome everybody here, and hopefully everybody is not too exhausted from these wonderful days and meetings we've had. Let me introduce everybody. I think everybody knows everybody. We're in a different order than I had, but to my immediate left is Joachim Levy, who's the Minister of Finance from the country of Brazil. To Joachim's left is Kuroda-san, Hirohiko Kuroda, who is the Governor of the Bank of Japan. Then we have Benoit Cœuré, member of the Executive Board of the ECB, and I'm sure he'll have a lot to talk about today. Mark Carney, the Governor of Bank of England and the Chair of the Financial Stability Board. And to Mark's far left is Min Zhu, who is the Deputy Managing Director of the IMF, who's making sure we are doing what we say we all do and making sure we have an organized world. So I wanted to set the tone and talk about the world. And as I was reflecting on it, I was reflecting on this exact meeting last year. So last year, as smart as we all were, we never talked about oil. It was going to go down from 100 to below 50. I don't think we ever heard of the word ISIS. We didn't certainly talk about the Ukraine and Crimea. We were confident the Federal Reserve was beginning to tighten. And I would say the overall tone of the committee, of the group, and also the mood at Davos was that Europe was healing very rapidly. And so, everyone, I hope we're going to be a little better this time. And I would say coming into this session, it is my observation, there's quite a bit more pessimism throughout the whole session this time from last year. So, as I said, last year we came away very positive. I think in some cases that was probably true, but in many cases, obviously, it wasn't so. So, with that set up, and we're going to go and talk about the world today, but I also want to bring up the world with technology and how we navigate that as finance ministers, as governors of central banks, and as the IMF thinks about it. But before we do that, let's go talk about some of the most pressing issues of the world today and the events of this week. So Benoit, let me start with you. You had a busy week. I think the marketplace is approving of your actions, but more importantly, can you tell me in the audience, what were your views of Europe going into the meeting, and importantly, the consideration of quantitative easing? What did you think that will do for Europe and Europe's future?
Well, thank you, Larry, and good afternoon. Well, that was certainly a momentous week, and it had become pretty clear that we had to do something, given the weakening inflation prospects. And you know what? Our life is simple. We have a pretty clear mandate. That's inflation going back to 2%, close to 2%, below 2%, as we put it. And we had to do something. So that became pretty clear. And in the last days, the only discussions were on how to do it. And that was a discussion. We learned from what Mark did. We learned from what Kuroda-san did. We learned from what the Fed did. But none of it is directly applicable to Europe because it's totally different. We have different market structures. We have a different institutional setup. And we are absolutely unique in one dimension, which is that we have one single monetary policy for 19 governments, 19 treasuries. So anything we did had to be fit to our purpose, it had to be fit to our unique situation. And that was really what the discussion had to focus on in the last days. Then on the question, what can we do for Europe? Well, we can't do everything for Europe. We all have a job to do. We've done our part on Thursday. Others have to do their part. And there is nothing we can do as ECB, as central bank, that can lift the growth rate of Europe in a lasting way. That's about productivity. That's about having the right business environment. That's about having people want to invest. We can make it cheaper to invest, but people have to want to invest. And that is really the role of finance ministers, that is the role of government. So we all have a job to do.
Was currency a component of the deliberation, and was there a view where currency would ultimately go then?
The currency?
Yeah.
It's part of the channels. It's probably not the most important channel. Mm-hmm. We don't have targets, as you know very well. We don't have numbers. The currency adjusts on markets. It floats. It's freely floating. It adjusts as a result of monetary policy decisions. So it's part of the transmission. It's not the main consideration.
So, Mark, I want to go to you first, and I may come back to Benoit. As the chairman of the Financial Stability Board, quantitative easing creates, in some markets, some distortions. You see very low interest rates as a result of these purchases, large-scale purchases by central banks. You have, depending on the maturities of these purchases, you have a flattening of the yield curve. And you have behavior changes in the marketplace, and I'm sure those behavior changes are anticipated, but those behavior changes will probably lead to more movement towards higher yielding, less liquid instruments. And what we've witnessed in the United States, and we've seen now in Japan, it moves huge volumes of money into the equity markets. There are some governors in the world have talked about bubbles or things, and I don't know if these are unanticipated, but you spend a great deal of time focusing on macro-prudential risk. And so how do you navigate the issue of making sure that the economies meet their targets, meet their inflation targets, and yet these methods, QE, creates true market distortions?
Well, let me begin by welcoming the steps that the ECB has taken and the way they have taken them. But your question's very on point, because in order for this to be effective, a number of things have to be in place, including a framework to ensure that we maintain financial stability, not just in Europe, but globally. And we're well aware, the ECB, the Bank of Japan, the Fed, the IMF, Bank of England, certainly, that in an environment of low interest rates, and low interest rates for a period of time, and also quantitative easing, there can be excessive risk-taking. But let's break this down, because what those monetary policies are looking to do is to move from an environment of reticence to take risk to responsible risk-taking, ultimately responsible risk-taking in the real economy, and we're trying to avoid reckless risk-taking. Now, reckless risk-taking is built on false assumptions. There's a few potential false assumptions. The first false assumption is that there's a central bank put. That the central bank will always and everywhere be there to protect against downside moves in asset prices of any type, first point. Second point, and the second false assumption we're particularly concerned about, is an illusion of liquidity that has existed in a number of financial markets. Now, I would say that illusion of liquidity is gradually being disabused. We've seen over the recent months a series of jump to illiquidity, if you will, including in the most historically liquid markets, such as the U.S. Treasury market.
October 15th.
So what are we doing to reduce financial stability risks in this environment of appropriately loose or appropriately accommodative monetary policy. First and foremost, it's about shoring up the core of the financial system. In other words, the major banks that are at the core of the financial system. It's why we increased capital 10 times, capital requirements 10 times. It's why the European authorities went through the AQR and the stress test and ensured that the 125 largest banks at the core of the European system are appropriately capitalized. It's a much better transmission mechanism, but they're also better protected in these bouts of illiquidity. And I will say, in my roles as Governor of the Bank of England and Chair of the Financial Stability Board, I can get daily position, mark-to-market position, all the global banks, and in these bouts of illiquidity, the losses, when there have been losses, have been very small. So the core of the system hasn't amplified this illiquidity. The second thing we're looking to do is to reduce the amplification channels from the core of the system out. 2 points, and I'll end with this. The traditional channel, the channel we all lived through in 2007, 2008, 2009, was through securities lending markets, repo markets, and straight securities lending. Bouts of extreme illiquidity, haircuts go to the moon at the same time that VAR goes up. Sorry to be technical, but that's the dynamic at the core. So we put in place, through the Financial Stability Board, the major central banks, major authorities, minimum haircut requirements which will dampen those ups and downs. The big question for us now, and includes your institution, number of institutions are here and watching, is what about liquidity cycles that come from those fund managers that actually don't have leverage? They do maturity transformation. It's 35 trillion plus of daily liquidity. Mutual funds, I'll simplify, mutual funds or UCITS, those types of firms that have daily liquidity but actually invest in relatively illiquid securities. How do they manage their liquidity? And to what extent can the system as a whole get liquidity to them so that in these bouts that we expect to happen increasingly by design, because we're pushing liquidity risk into the private sector, how can they dampen them, make them work? So it is your question's on point because it's front of mind. We've taken the first major steps, which is why it is appropriate, not just for monetary policy reasons, but for broader financial stability reasons, that the ECB has acted as they have this week.
And I could ask this to Benoit or you, Mark. In some there are some people who believe that QE it creates more issues, social issues in society because there are big winners and big losers. Those who have capital in financial assets are generally big winners, and those who don't. And so it creates a greater fragmentation in society. Do you have a view on that, either one of you?
Well, I think that's a very deep question. We know that large-scale asset purchases entail risks. As Mark said, it entails financial stability risks. And on that front, I can say that we feel safer now that we have single supervision. And it's not me doing supervision, by the way. It's separate within the ECB. It is Daniel Nui and Sabine Lautenschläger. And they're great, and they're great because they're tough. And they will be tougher than their predecessors. And if we have tough supervision, we feel safer to have loose monetary policy. And it also entails risk, as you said, the risk to widen inequalities. We have to be extremely mindful of it. My answer would be that the best way not to increase inequalities is to have good policies to support the poorest and to create jobs at the lower end of the wage ladder, at the lower end of the skills ladder, because these are the ones who are unemployed. And in the case of Europe, that is mostly structural. That is mostly about making labor markets work better. So if we make labor markets work better, in complement to large-scale asset purchases, then you can have the best of both worlds. You have expansion, and you don't increase inequalities.
So Benoit, should we expect to see a more vocal ECB related to those items and importantly talking to the finance ministers of the various countries on those mechanistic ways of improving inequalities within those countries, more reforms?
No, we'll certainly speak our voice. We'll start on Monday, actually, in Brussels.
There we go, Monday.
Where we have the Eurogroup meeting. and this will certainly be the discussion. But that said, it's not a bargaining. It's not a quid pro quo, obviously. And as I said, we all have a job to do. We do our job. They do their jobs.
Just let me make a very basic point. All monetary policy has distributional consequences. Yes. We lower interest rates. It benefits it benefits debtors, people who owe money, at the expense of the people who've saved money.
Yeah.
And I can assure you, I hear from savers and understand that.
I do.
Absolutely. The point here, and it was a point in the U.S., point in the U.K., that one of the biggest distributional issues is the risk that people are unemployed for too long, they become detached from the labor market, they lose their skills, so-called hysteresis. So there has been a race against hysteresis. In the UK, where we've created over 600,000 jobs in the last year, where the unemployment rates dropped down below 6%, where wages are starting to pick up, we're winning that race to the extent you can from a monetary policy perspective. But there are profound other policy issues that are necessary, and they interact with I think your last topic on technology, to make a real difference. So just to summarize, monetary policy always has distributional consequences. There are broader policies that have to address them, and they can be redistributive or structural more broadly, and we need to recognize that. But if we don't get the basics right, we're not even in the conversation.
Let's hear from Min related to these issues, because these have big consequential issues for the IMF. And so how do you think about these issues?
Yeah, the first issue is I would like to say we welcome ECB's decisions. When we talk about ECB's policy, we talk all these consequences, right? But the key objective is create a space for structural reform and for investments for growth. As Sabine mentioned, I would like to re-enhance that point. I think this is absolutely important. I think the European is in a good position today because we have more monetary space. We have a little bit of fiscal space because the oil price is so low. So it's absolutely important leverage the opportunity to move forward the structural reform. And so much talk about structural reform. I don't want to repeat anything. But I want to mention one thing, this is investments. If you compare today with 2007, the investment share in GDP in Europe lost 5% of GDP. Right. This is a big gap. If you lost 5% of GDP investments in 7 years, how can you have a strong growth? This is not including infrastructure investments. It's more today, it's investments in knowledge economy, investments in long-term R&D, investments in innovative SME. I think this is all European needed. So I would emphasize, when we think about the monetary policy and we think about the QE, I think that we need to carry out firmly on the structural reform and the investment projects. Now, I fully understand it's not easy because it's not easy go through the political process to the structural reform. But the great challenge call on the great leaders, right? I think this is the moment. Either the history choose the leader or leader change the history.
Well, we first have to educate the population in voting in the right leader to do that then, right?
That's exactly, but also depends on the proposal.
Yeah. Let me turn to Kuroda-san. You've been very bold in your actions, and you've been consistently bold. I'm still looking for the third arrow, so if anybody in the audience has it. Sometimes I feel like you are one of the most lonely men in the world because when you started this ambition plan, I assumed we were going to have more support, like what Min was talking about in terms of policy. So, where is Japan versus where you thought Japan would have been after this two-year program? And where do you believe this third arrow will begin, and how successful will this become?
Yes, thank you. But before going to Japan's situation, maybe let me say one thing about the global economy. As you indicated at the outset, some pessimism prevailing in Davos this year, I think is a bit exaggerated because I think two good factors which could boost the global economic outlook in in the next couple of years, we have to carefully assess. One is, of course, a substantial decline of oil prices. I mean, 50% oil price decline could accelerate the global economic growth in coming years. The next factor, positive factor, is, of course, a big decision by ECB. This QE is certainly quite significant with somewhat open-ended nature, and that would greatly improve the world economic outlook, because after all, the Eurozone is the biggest economic unit in the world, bigger than the US. So these two factors, lower oil prices and big decision by ECB, could further improve world economic outlook. I think
Currency, too.
yes, euro has depreciated somewhat, but as Benoit emphasized, ECB does not target the exchange rate like Bank of Japan, and it's only one relatively small part of transmission mechanism, and by making this big decision, the Eurozone could recover strongly, and deflationary pressures could be eradicated. Then that would be great for the global economy. Now, coming to Japan, the so-called Abenomics was started 2 years ago with 3 arrows, namely aggressive monetary easing, fiscal stimulus in the short run, but coupled with medium-term fiscal consolidation, and thirdly, substantial structural reforms to raise potential growth rate toward 2%. Aggressive monetary easing, certainly, Bank of Japan has been implementing, and the so-called quantitative and qualitative monetary easing, QQE, started April 2014, was further expanded last October, and the inflation rate has been steadily improving. Although in the last couple of months, because of sharp decline of oil prices, headline inflation slowed down. But we think that eventually inflation rate would accelerate because of strong positive impact on the economic growth in Japan of substantial oil price decline. Now, how about the third arrow, as you said? Actually, there are many things done, although there are few which have been very noticeable. One of them is substantially increased female labor participation ratio. In the last 2 years, women's labor participation ratio increased by 3 percentage points, reaching the historic high level. Although the level is still somewhat below, somewhat lower than the OECD average, so that there is still room for increasing female participation ratio or the women's greater activities in the society. But this is somewhat neglected by foreign investors, but this is really important. And many Japanese companies now have female senior staff. And foreign workers, foreign talents, the government last year decided to relax visa policy for construction workers. And now the government is likely to further relax visa policies for talent, foreign talents, experts in other sectors where labor shortage is quite acute. Labor market reform also is a big issue. TPP could ignite the Japanese agriculture sector and also the service sector. Recently, the government decided to significantly reduce corporate tax burden in the next 2 years. And also they are determined to further reduce corporate tax burden so as to not just encourage Japanese companies to invest more in Japan, but foreign companies to come to Japan and invest in Japan. So I think structural reforms, deregulations, they are very important in the long run, and they would have significant impact on growth potential. But by nature, it takes time. They take time. So I hope people are slightly more patient.
Kuroda-san, you know the markets are never patient, so.
Can I jump on Japan issue? Because I think we should not be that patient. Because see, Japan has a pretty good chance to pick strong growth this year.
Yeah.
Because the basis was very weak last year, almost zero. And you, Mr. Kuroda, create a money space, exchange rates are very low. The government have a fiscal stimulus package, right? And the low oil create a huge fiscal space and for you. So I think you have a lot of market space, fiscal space, exchange rates, and facilitating all the growth. So I think it's a good window opportunity for Japan to firmly carry out the structural reform and move the whole thing forward. I think this is a very important period. So we should not be, from IMF, I would say that, and from Japanese point of view, maybe Japanese should not be that patient. The world should be that patient either. But let me point out one thing. On patient issues, but there's a one downside. But there is one issue when I expect to see Japan pick up with pretty good growth. But one thing, I will see you carry on structural reform. But one thing is, when you have a good growth, we have to put physical consolidation back on the table. Because when you have 250% GDP debt, it's without a strong inflation, a strong growth, it's very difficult to bring them down. You pay interest rates. 10 years ago, you have a roughly 150 basis point of 150% GDP. It's a 1.9% of your GDP. Today, you almost double how much you pay, 2%. So you are very sensitive to interest rates. And interest rates is really on the upside. So I think Japan should not be patient on fiscal consolidation side.
Min, I hope you're this strong also for Europe, too. Benoit.
Maybe
That's exactly what I wanted to say. I mean,
Good.
I've been listening extremely carefully to that discussion, and I will stand on Min's side that in the case of Europe, being patient is just a risk that we don't want to take. We need growth in Europe, and we need sustainable growth in Europe. And that also has to be with the politics of the European project. With low growth, entrenched unemployment, people being dragged out of the labor market, we are seeing the whole political foundation of the European project being weakened. And this cannot last for too long.
Maybe. 2 points to respond to Minju. First on patience. Of course, I don't want to say that we have to be patient about the way the government implement those structural reforms. We should not. We should request, demand the government to make necessary structural reforms, deregulation, as quickly as possible. But impact on the economy takes time, because if you improve the environment for investment by the corporate sector, yes, the corporate sector would respond because now they have much lower corporate tax burden. But that could take time. And then the final impact on the potential growth rate, again, would take time. So that we should be patient as far as the final effect on the economy is concerned. But action should be taken as quickly as possible. In that sense, I agree. Second point, fiscal consolidation. Again, I agree with Minju. The government set the so-called medium-term fiscal consolidation plan, under which the government is required to halve the primary deficit by fiscal 2015, and that government actually implemented under the current budget for fiscal 2015. But more difficult, challenging goal is to completely eradicate primary deficit by fiscal 2020. That requires much more effort by the government, but the government has already made it quite clear that by summer this year, they would come up with a more concrete plan to achieve that primary surplus by fiscal 2015, meaning that some revenue enhancement measures as well as expenditure cut measures would be specified. And that is quite necessary because, as you said, the government has accumulated so much debt already, and the appropriate and reliable fiscal consolidation plan is absolutely necessary for Japan.
I'm going to move on to the emerging world, but also talk about how I believe the emerging world is going to become much more of a world of divergence. The emerging world is going to see many more success stories than we've seen in the past, and many failures. You just look at the oil markets and how we've created some big winners and big losers. And also the marketplace, talking about patience, is starting to lose its patience related to the emerging world. From my perspective, I think the actions from the ECB and lower oil prices overall, I look at it as a great opportunity to be in the emerging world. And I actually believe where interest rates are now in Brazil, it's a great investment opportunity too. So with that framework, Joachim, give us your perspective from Brazil, of Brazil's position, but also of the entire emerging world and how that's going to play out.
Well, thank you. Good afternoon. Brazil, in some ways, comes from a very different direction. We have had a lot of job creation in the last few years, several million positions. We have now one of the lowest unemployment rates in our history, actually the lowest. Incomes have been rising in the last years. There's been a lot of inclusion. So our experience is somewhat different. But to some extent, this process started to slow down in the last couple of years, in part because of the changes in commodity prices, changes in the whole emerging market. And we decided to change. Actually, you had an election last year. Change was one of the most talked about words. And we decided, the government, the president decided that the beginning of this year to take some actions. And these actions basically aim at reinforcing investment. We for some time, our growth was much based on consumption, but we are shifting a little bit of the demand towards investment. Now, to get investment going, as we heard, you need confidence, you need less uncertainty. So we're taking some measures to ensure that confidence in the economy increases. Because last year we had a decline, a quite important decline in investment, in part because there was election, there was some uncertainty, so now we're trying to take this out. The biggest factor for the slowdown of the economy last year was the decline in investment. Now, what it takes to get investment coming back, like I said, you have to build confidence. Now, the tools that we are planning to use, that you have already started to use, are very traditional tools. We are strengthening our fiscal, so our primary surplus, we decided to have a primary surplus of 1.2% of GDP this year. Is a significant increase, more than 1% of GDP increase. Next year, we rise a little bit more. We are also getting prices realigned. This could be called a sort of a structural reform. So in areas like energy and other areas, you get price signals that are very important for investment decisions. We are working on that too. Even the regulatory framework, in some cases, we are attentive. Why? Because we need not only investment, say, by companies and machinery, but also infrastructure and with the private sector. And we know that for that to happen and to happen quickly, we need to have really a framework that provides full confidence. Now, Brazil has a good track record on concessions, PPP, and so on. So we are confident that we can get this moving. And this is very important because this is what will allow us to continue the path of improving education, skills. Like I said, we created several million jobs. We have a population that's relatively young, and they are now getting more skilled, more people in college, doubling the population in college. So we can have demand, but perhaps with a different composition, a composition that helps us to increase our potential growth. Of course, this has a component of structural reform in it. Basically ensuring that it's easier to do business in Brazil, that it's easier even to pay taxes in Brazil. There are a lot to be done in these areas. And we believe that if you act fast enough, we're going to have the response. In Brazil, Lawrence, often when you have these shifts, the economy, the enterprise, the companies, the workers, they react very quickly. Perhaps we're not as flexible as the United States. Maybe you are in between Europe and the United States, but it's an economy that is very agile, that responds. And I would say that a number of emerging markets are also like this. Some of our neighbors in Latin America also are nimble and are moving. And I think that the benefit of lower energy prices will make this transition probably easier for many of us. For Brazil, although you are a large producer of oil, on balance, I think that the decline in oil price will not hurt us that much. It will actually be positive. So I think this is the kind of action that countries like us have to take to ensure that in this world that continues to change, we move ahead on the productivity ladder, on the technology, and for that, private sector is fundamental, and to get the private sector, you have to have the right environment.
So
Larry, let me say.
let me just ask one question before we go there, man.
Okay.
I hear what you're saying is you expect better GDP from your country and other emerging countries because of the oil situation?
I think for several of them, yes. In some countries, of course, I mean, like I said, emerging markets is a very different bag, okay? There are some that are producers, but even in some of them, I take our well, let's call it neighbor, Mexico, okay, they are a producer, this will reduce some of their revenues, but because they are also doing structural reforms, well, it may hurt a little bit, but you move forward, and that's the important thing.
Yeah, Larry, I disagree with you, although I understand it's very risky to disagree with the moderator. And when you say the market disappointing about emerging market,
You can disagree all
yes,
the time.
emerging market growth is on downside in the past few years. We observe 92%. Almost all the emerging market growth rates has been down continuously in the past few
That
years.
was my point.
May continue to little bit of lower in the next few years, but that's because cyclical reason. Because they have a different business cycle, they are in the maturing cycle. They have a very high, strong growth in the 2009, 10, and they are gradually coming down. Some countries have missed investments. Some countries have overheated credit bubble. They have to adjust. So I think that they are gradually slow down, adjust themselves. This is the process. But in the past 20 years, emerging market really built a very strong fundamentals, and that's built a base for them to move forward. Now the key issue is there's a big structure change within the emerging market and between emerging market and advanced economy. Globally, it's very interesting. Between 1990 to 2010, in 20 years, advanced economy consumption into the share of GDP increased from 75 to 80%. Now, it's Econ 101. When you have a C increase 5%, what do? Your investment drop 5%, right? You have to have a number add up. That's okay. The really thing happened in the emerging market. Where advanced economy consumption increased 5 percentage points, emerging market reduced their consumption 6 percentage points, increased their investment 7 percentage points. We're living in such interconnected world. Everything have to mirror to each other. Now, that's the point. The point is we start to see the advanced economy consumption gradually slow down, a little bit of investments they have to pick up, and the emerging market is readjust themselves, reduce the investments, increase the consumption. There will be big global readjustments.
Right.
I'm not sure what level they will be able to go back, but I'm pretty much sure most of them will go back. I think that's a very important global reshifting, restructuring. I think the policymakers have to pay attention on those issues. The second point, before I finish, to give you another 30 seconds, is the emerging market is a very big chunk of a global economy now. They account for 50% more global GDP, 60% of global investments, contribute more than 60 and 70% global growth. Now, but they still have a very low per capita GDP. They only, in average, have a 22% of U.S. per capita GDP. That means long way to catch up. That means a great growth potential. I would say after 100 years, when we come back to this podium to have this meeting again, I'm sure we'll be able to live to 150. Klaus is here, maybe you're older than us, but I'm sure you will be there. I think that we probably will not remember this financial crisis because this is just one financial crisis we experienced in the past few hundred years, but people will remember. This is the year emerging market take half of the global GDP.
So I was just going to say, Kuroda-san, it sounds like you're right. Everybody's bullish. Everybody's bullish.
Just a comment. Like I mentioned, emerging markets really broad denomination. So among of our countries, there are some that have, let's say, the investment to GDP ratio above 30%, and others have below 20%. So some of the things that are absolutely necessary for some, perhaps reducing investment. You may even have the contrary in others. I sometimes joke that, for instance, comparing with China, we have done some of this yin and yang, and you have now to turn it around. So it's important for Brazil to increase investment, and I see that China and maybe others are in the direction of really getting the fruits of growth and development more to the consumer, and that's also healthy.
Yeah.
Mark?
Extremely, very important point, the last point there about the transition that's going on in China, lest we forget the scale of the readjustment there, and I'll make a broader point. There's a series of transitions that are underway, and some of them may come to a point this year. So I think it's valuable to sit back within an overall posture of being cautiously optimistic about the outlook is where I would put myself. 3.5%. If the IMF's right about global growth, that's a good outcome. These transitions in emerging markets towards more domestic demand. I mean, Brazil's there, but China. This is hugely important. Secondly, the potential transition of some advanced economy monetary policy in the greater divergence in advanced economy monetary policy will bring, likely, if it happens, likely a benign, in other words, a benign increase in volatility, and will test capital flows across the global economy, including to emerging markets as well, and will test the new financial system and the resilience of that new financial system. So we should be conscious of that because it starts with a positive, but has a potential feedback, and we have to be aware of that. On top of that, I think the energy market adjustment, we've all observed the dividend from oil. It's realistic to expect, it doesn't mean it will happen, that oil is lower for longer, given where cash costs actually are in across the globe, and given where demand is likely to be. So that creates an opportunity that is considerable and perhaps undervalued in terms of the outlook for the global economy. And lastly, if I can bring it back towards Europe for a second, there's a transition from everything being about monetary policy to everything being about structural policy, and I would include in structural policy completing the project of a sustainable monetary union, just parenthetically. In the UK, transition from household-driven growth towards more investment-driven growth as well in the context of a rising global economy.
Go-to-Sun.
2 points. One, on China. I really think that the Chinese economy is making huge structural change. People may be more interested in gradual slowdown of economic growth, but still China is growing by 7.5%, and even if slightly slowing down this year, next year, but still around 7% growth. That is very respectable rate of growth. But more important is Chinese economic structure changing. It is not anymore export dependent economy. It's more domestic demand oriented economy. And not just investment, but also consumption is increasing. And even in China, consumption basket consists of not only goods, but large part of services. And services do not need so much input of materials or those kind of things. So that Chinese are going to gradually slowing down, but China's import of materials, commodities, as well as intermediate goods, is declining quite significantly. That makes the supply chain matrix in China, centering China, I think it's changing. This is a big structural change. It is good for China, it is good for Asia, and supposedly good for the world.
I need to move the discussion because we've been doing this like for 50 minutes. I don't know if I heard the word U.S. yet. Mm-hmm. A minor colony.
We'll let it back.
What's that, Mark?
We'll have it back.
Yeah.
If it wants to come.
Yeah, so, from all of your perspective, when you think about your monetary policy, your actions in Brazil, the ECB's monetary policy, and the Bank of England, and from the IMF, what are your predictions of the U.S.? I mean, you had to make these decisions based on that fundamental, I believe.
I missed the second point. Second point, just I say that the Japanese economy is likely to grow around 2% in fiscal 2015. It's not calendar year. So IMF WO is based on calendar year, which is a bit too pessimistic, but the difference is not so bad, not so big. But anyway, in fiscal 2015, we expect the Japanese economy will grow around 2%. Now, the US economy, I am extremely optimistic because the growth is so robust, not only in consumption, but also investment and also export. So I think the US economy is currently, of course, leading the global economic growth. And the economic growth in US is much more broadly based than before. So I have full confidence in the US economic growth.
Well, I don't have a prediction for the US. It's difficult enough to predict for oneself, so I'm not doing that. But for sure, the US economy will be strong. For sure, it will be stronger than the Eurozone economy. Our priority in that environment is that we want to be sure that the financial environment will remain fit in Europe, to the European economy, in the US, to the US economy. And for that disconnect to happen, we need well-functioning international capital markets, which brings me back to Mark's remark that the system is untested to some extent. We had a wave of new financial regulation, which by and large has focused mostly on banks. So we're pretty sure that now banks are much safer as financial institutions. We're less sure that financial markets, capital markets are safer. So that will be the priority of the regulatory community. We want to be sure that international capital markets work. And for that, we'll need an adequate degree of coordination. So we need to fight the temptation of ring-fencing financial protectionism, and that temptation is very often at home. It's in our heads.
Yeah, I would agree with these observations. As Mark mentioned, we may see some dislocations as a consequence of the current trends. The U.S. growing, it's good. It's good for Brazil. It's good, I'm sure, for several countries because of the demand it creates and so on and so forth. But especially a country open like Brazil to capital flows, we will be very watchful. And I think coordination will be very important. We are also strengthening our own situation, and when we strengthen fiscal and so on and so forth, it gives us an additional layer of protection if there is any dislocation in capital markets. But it's something that you have to watch very carefully and coordinate if something happens, and not the least because of the lower level of liquidity in so many markets, bond markets, and so on.
Mark? Let me I'll reinforce what my colleagues just said on that point. I'll make two others. First, as I think many are aware, there's a big difference between the path of monetary policy implied by the Fed through the famous dot plots, and that implied in the market. And that gap will close somewhat this year. And the question is, in what direction will it close, and what impact that will have on volatility? That reinforces the importance of investors and, more importantly, people in the real economy, businesses, households, understanding the objectives of a central bank and how we'll react to certain circumstances. And I think the clarity of the Fed's mandate, the clarity of the ECB's, and very much the clarity of the Bank of England's mandate, if I just say one word on the UK, which is that we have a very low inflation environment right now, largely caused by commodity prices. We have an ability to look through that, and we have a responsibility. We have the means and the will and the responsibility, and we will do it. We will return inflation back to target within the 2-year horizon so people can rely on that. Now, the second point I wanted to make on the U.S., and I'll hand back to you, which is around the labor market and the question, which is there, as yet unresolved, about the impact of technology on wages and potential dynamics that has for the Phillips curve. And therefore directly for monetary policy. And this is a fluid situation, and if in any labor market this is would be in the most flexible labor markets, which would include very much the US, but also potentially the UK. Just again, parenthetically on the UK, it is not lost on us that wages are picking up now in the most recent data. consistent with our expectations.
Yeah, on U.S. side, if I may also have 2 points, I follow Mike. I think I agree, U.S. will have a strong growth this year, and 3.4 we forecast is very strong, no question. But if we decompose the growth, if you're looking for the growth is very much driven by private consumption, right? And also a little bit of government expenditure as well. Investments are still weak. You compare today with 2007, in terms of percent of GDP, U.S. lost 2% of GDP of investments. So put the U.S. on the long-term sustainable growth, I think U.S. also need investment when corporate sit on the big pie of that. The second issue is the risk in financial market, as Mark mentioned, really start to accumulate now. I mean, the illusion of liquidity, Mark just referred to, I think it's, and moving from banking to the shadow banking sector, Larry, you may disagree with me, but if you're looking for the number, the credit from banking sector to the corporate sector in the past 7 years dropped really $300 billion from on the shadow banking sector increased $1.4 trillion. So you will see the credit intermediation really moving away from traditional commercial banking to the shadow banking sectors.
But that's not bad.
Yeah, exactly.
Okay.
No, I'm not saying good or bad.
Okay.
I know you would disagree, but I'm glad you
No, I didn't. I'm not disagreeing. I'm not defending myself. I'm going to move on for a second because I don't want to talk about.
No, it's not bad. I agree, but I think there's a potential risk. We need enhanced regulatory efforts and supervision as well, as Mark mentioned.
So let me move on. I want to take up a point that Mark brought up, and I think it has great implications for the developing world. And Mark brought up technology, and obviously. Technology is a major component in the future of technology for the World Economic Forum. And when we frame out 2014 and how that's translating into 15, in my mind, it was technology that transformed the energy market. It was technology that created the 1.6 million excess barrels at a time when global demand was growing much slower than it was a few years back. And so we had this structural imbalance of supply and demand, and now we're in a period of equilibrium. And the smartest brains in the world and everybody no one predicted what technology was doing. We witnessed it, but we didn't understand the implications. But technology is beginning to change most industries we live in. You know, the digital world is changing so many things. The sharing economy, we're accustomed to sharing music. Very few people buy music today. They use.
I buy all my music.
You buy, me too.
Yeah,
but we're old.
Just to be
Mark,
clear.
we don't count. Yeah. My kids really make fun of me that I still buy CDs. So let's move on that point. And then now we are migrating towards cloud, exactly. And everyone's talking about the cloud. We're reducing the need to buy these big hard drives by having that. We have Uber now, the sharing economy of automobiles. You know, patterns are changing, behaviors are changing. Most of these patterns and behaviors have shown to be disinflationary. I'm not saying they will always be there, but it's also changing the job creation. And so as bankers, as finance ministers, IMF, how do you think about technology when you think about policy? Because technology, in my mind, is underappreciated at least by politicians, as to how that's transforming their societies. And I do believe technology is going to be very disruptive in the developing world, because technology, you're seeing technology transformations in China right now. They're using more robotics. We're seeing technology transformation in agriculture because of the combines, and we don't need that many humans now to pick so many agricultural products. This is going to be disruptive in so many places, and it's going to be those countries that adapt to technology are going to be the winners, and those who can't adapt, in my mind, are going to fall farther. So big winners, big losers. How do you think about that in monetary policy first, and I'll ask in governmental policy, since we have three governors in the center? Mark?
Well, I think there's three ways. First, in terms of financial stability policy and the change in banking that is imminent, we have to get the balance of regulation right. not come down too hard and prevent this, this type of disruptive technology, but also not be in a position where we're filling in prudential regulation after the fact and then have a difficulty. In other words, facing an Uber-type situation in financial services, which many jurisdictions are struggling with. Secondly, on monetary policy, we have the classic thing of adjusting CPI for true, true value. But this goes to the labor market. I'll finish with this. And it's an imperfect analogy, but you think about the sharing economy and the classic thing of the vehicle, I think in the States, is only used about 5% of the time, and so this is tremendous opportunity to share vehicles, and it's an efficiency, and it lowers actual investment and purchases, but it's more efficient for the economy. Think about labor. We have a very high share in the UK, a similarly high share in the US, of involuntary part-time workers. And you also have a phenomena, and it's hard to measure this precisely, of disaggregating services. So outside, having contractors outside of the company, contractors that work to specific tasks, aren't necessarily working full-time. And so there is a sharing element there that's not being, and so we, as monetary authorities, we have to take an assessment of how much extra slack is in the labor market because of this phenomena. And that's trying to make a judgment in terms of shorter term, cyclical monetary policy in the face of a broader secular trend. So these are very difficult judgments to make.
No, I fully agree with Mark, and thinking about trying to reflect on your question.
But you don't buy CDs.
Sorry?
You don't buy CDs.
I do buy CDs.
Oh, okay.
I do buy CDs. I don't buy vinyl, but I do buy CDs. There are certainly many ways in which technology will reshape monetary policy as it reshapes our daily lives. And the whole question is how can it be reshaped in a way that it's not disrupted? Because we need monetary policy to provide confidence. And apart from what Mark said, it's pretty obvious that that technology is reshaping the financial industry. I mean, you've been discussing that here since the forum started. It reshapes payment systems, which are essential for monetary policy, which are really the nuts and bolts of what we're doing. So we're following very closely virtual currencies, for instance. We're following very closely the cyber resilience of financial infrastructures. This is essential for the smooth transmission of what we're doing. It certainly reshapes the economy, and Mark has commented it. Simple issues such as where is the Phillips curve in the Eurozone? Well, I don't even know, and it might become even less clear as depending on the assumptions you make on productivity and on the impact of technology. And this is crucial also to our monetary policy making. It may change our instruments. If you think of an issue such as negative rates, we've been experimenting with negative rates. And people outside, such as, Ken Rogoff and others, have suggested that negative rates might become less of an issue if money migrates to electronic money. Because so the effective bound...
If we have more consistent, longer negative rates, should we all go in the linen business and buy pillows? And, is that the next new business?
What I would like to see is the natural rate of interest going up, and that's also about technology. And then we don't have to face that question. And finally, and that's maybe the most intriguing question for me, technology can reshape politics. And we're not doing politics, but a stable currency requires a community of interest, a commonality of interest, especially in such a diverse region such as the Eurozone. And social networks, technology have the potential to reshape interest groups, to reshape politics in a way that can have an impact on monetary policy.
Yes. Rhoda-san.
I think we have to differentiate digital technology or information and communication technology from larger area of new technologies. As far as the financial sector is concerned, and also central bank as the host of payment and settlement system, digital technology is quite vital and quite important and decisive factor. I agree. But as far as the real economy as a whole is concerned, I think robotics or biotechnology and so on and so forth, those new technologies, various new technologies could affect the entire economy in a very significant way. And so as a central banker, we tend to focus primarily on digital technology, payment and settlement system, the financial sector, financial market. But I think we should broaden our view, our way of thinking toward greater areas of new technology.
Well, I think that for emerging markets, technology may have, at least in the short period, the medium term, a different impact than in developed countries. Sometimes it's good to be a latecomer. Kuroda-san just mentioned payment systems. Brazil did an overhaul of the payment system in the late 90s, early 2000s. We got a very robust, modern, nimble system. Technology, for instance, in Brazil now is playing roles such as, I mentioned, we have grown quite a lot the number of students in colleges. Now, the ability to have courses through media instead just 19th century or 18th century technology of classrooms and so on is a major factor. Not the least because you take a generation to train teachers to have to double, triple the number of people in college. So if you can use in a smart way these means, you have a tremendous impact on the life of many people. You make so many things affordable that were not affordable before. Also, I think that in some ways, because actually, even because of income inequality, you have a larger group at the bottom, let's call it the pyramid, from that in the middle. And the middle is the one that is now feeling the brunt of the change in technology, especially information. So they may lose a little bit, but the gain at the base is so big that overall for the country it's fantastic. I mean, you can use cellular phones. I mean, for very little price. You mentioned, for instance, in the fields, but the guy in the fields now can know about the weather, can know about the prices, can know about everything, even fix the tractor if necessary, just with a small thing. So you get access to so many things, and that for the majority of the population, that it really has an impact that we're expanding your production frontier. And the thing we have to do, and again, the role of the private sector together with the good regulation is fundamental so that you have a rapid dissemination of this technology and make them accessible to as many people as possible.
Yeah, I think technology, I agree with you, will have a destructive impact on the emerging market as well. I think it's a huge challenge, but it's a huge opportunity. Net to net, it's good news. Let me say why it's good news. The Asian traditional development model is that Japan learn things from America, US, or US and Europe and take over, then transfer something to South Korea. South Korea transfer to what we call the four Asian tigers. Then China take over. Now with technology today, I don't think India want to take things from China. Vietnam takes something from China, but I will see they will jump into the front directly. So all the emerging market, China, India, Vietnam, and all the other countries, will jump to take the technology, jump to the frontier. The whole thing is all the advanced economy more or less within the production frontier, right? If you go back to Econ 101 again. So beyond the frontiers, you need to push forward. And emerging markets within the area want to go to the frontier. Today, with the technology, they can jump to the frontier. And even they can move further. If you look about Alibaba, that's a real case. Look, it's 500 million people have a smartphone in China. I think that's a huge opportunity for them. But technology actually impose a huge question on global governance issues. It's not all clear whether it's enhance the global governance or it's on the other way around. It's not all clear yet. We may put them into the more sort of multi-functions, non-state factor will play more roles, and how do we work together with modern technologies? I think that's a big challenge we have to seriously to face it.
Well, I want to apologize to the audience. We're not going to have time for questions, so I'm going to ask anybody, would anybody want to wrap up anything? Any final comments? Mark, it looks like you have one.
Well, let me just take the last thing Min said. There's been a lot of discussion of over the past year of secular stagnation and negative real interest rates. The natural rate is negative, and there's a variety of reasons why that has been the case in some major jurisdictions. It was the case in the U.S., arguably was the case in the U.K. That's why QE made sense. Arguably is the case in Japan and Europe, which is why QE makes sense, because it's bringing monetary policy to that natural rate, so it is appropriately accommodative. There are a variety of reasons for that, savings, investments, imbalance, et cetera. One of the reasons that's advanced for that is technology pessimism. Now, I would reject that for two reasons. I'm actually more of a technology optimist. It's hard to be at the forum and listen to all the advances that we're on the cusp on and not be a technology optimist. But more fundamentally, for Min's point, is that the vast majority of the world, the UK included, is not at the frontier. They are less productive than the frontier. So even if nothing else is invented for the next 20 years, just catching up is a huge growth it's a huge opportunity to grow
that,
potential.
But do you think it can lead to more disinflation?
It depends on the stance of policy, and it depends also on monetary policy, but also, yes, it has a disinflationary impact, first point. Depends on the stance of monetary policy and relatedly structural policies so that people can adjust. Because in this new technology world, particularly in labor markets, you're going to need more creativity. You're going to need mass creativity, and this is a truism, but it is true. You need lifelong learning, you need training, you need all these elements that are going to allow people to take full advantage, and that will take time. Sorry, Benoit.
Benoit, you got 30 seconds, and Kuroda-san, and then we got to wrap it.
I would just urge all those in Europe who worry about the impact of monetary policy on savers, and there are some, to listen to Mark. The answer is about the rate of return on capital. The answer is about the innovative capacity of Europe. And the answer is about the ability of our capital markets to reallocate resources to increase the rate of return of capital. And monetary policy is just the canary in the coal mine.
Kuroda-san.
I don't say that inflation is anywhere and anytime a monetary phenomenon. I don't think so, because the inflation rate could be affected by many factors. I mean, technology, emerging market participating in the global transactions, anything. I mean, at this moment, 50% reduction of oil prices are affecting inflation rate globally. But central bank monetary policy can counteract this inflationary or inflationary pressures through appropriate monetary policy.
Yeah, thank you very much for giving me 25 seconds, because I will feel very uncomfortable leaving this podium without talking anything about low-income country. Because the low-income country has a very strong growth in the past 20 years. This year, they are facing a lot of headwinds because the weak external growth, weak trade growth, oil price drops is very important for them, and the monetary policy divergence causes interest rates and exchange rates and currency market volatilities. But we believe with 20 years hard work, they build a good macro foundation to work further. But the whole world needs support to help them. This year is particularly important for development because we have post-2015 MDG to SDG. We have financing development in Ethiopia in July. We have a climate change. So I will say we request all the policymakers put development policy on the top of their agenda. Thank you very much.
Ladies and gentlemen, thank you very much. Panel, thank you. inflation targets, and yet these methods, QE, creates true market distortions.
Well, let me begin by welcoming the steps that the ECB has taken and the way they have taken them. But your question is very on point, because in order for this to be effective, a number of things have to be in place, including a framework to ensure that we maintain financial stability, not just in Europe, but globally. And we're well aware, the ECB, the Bank of Japan, the Fed, the IMF, Bank of England, certainly, that in an environment of low interest rates, and low interest rates for a period of time, and also quantitative easing, there can be excessive risk-taking. But let's break this down, because what those monetary policies are looking to do is to move from an environment of reticence to take risk to responsible risk-taking, ultimately responsible risk-taking in the real economy, and we're trying to avoid reckless risk-taking. Now, reckless risk-taking is built on false assumptions. There's a few potential false assumptions. The first false assumption is that there's a central bank put. That the central bank will always and everywhere be there to protect against downside moves in asset prices of any type, first point. Second point, and the second false assumption we're particularly concerned about, is an illusion of liquidity that has existed in a number of financial markets. Now, I would say that illusion of liquidity is gradually being disabused. We've seen over the recent months a series of jump to illiquidity, if you will, including in the most historically liquid markets, such as the U.S. Treasury market.
October
15th. So what are we doing to reduce financial stability risks in this environment of appropriately loose or appropriately accommodative monetary policy? First and foremost, it's about shoring up the core of the financial system. In other words, the major banks that are at the core of the financial system. It's why we increased capital.
I think the marketplace is approving of your actions, but more importantly, can you tell me in the audience, what were your views of Europe going into the meeting, and importantly, the consideration of quantitative easing? Did you think that will do for Europe and Europe's future?
Well, thank you, Larry, and good afternoon. Well, that was certainly a momentous week, and it had become pretty clear that we had to do something, given the weakening inflation prospects. And you know what? Our life is simple. We have a pretty clear mandate. That's inflation going back to 2%, close to 2%, below 2%, as we put it. And we had to do something. So that became pretty clear. And in the last days, the only discussions were on how to do it. And that was a discussion. We learned from what Mark did. We learned from what Kuroda-san did. We learned from what the Fed did. But none of it is directly applicable to Europe, because it's totally different. We have different market structures. We have a different institutional setup. And we are absolutely unique in one dimension, which is that we have one single monetary policy for 19 governments, 19 treasuries. So anything we did had to be fit to our purpose. It had to be fit to our unique situation. And that was really what the discussion had to focus on in the last days. Then on the question, what can we do for Europe? Well, we can't do everything for Europe. We all have a job to do. We've done our part on Thursday. Others have to do their part. And there is nothing we can do as ECB, as central bank.
Ever since Christine got there. It used to be over there. She likes that stuff.
fine. No. I've been through it.
I think we're going to get started. Good. Welcome, everybody. Let's get started. The faster we can assemble everybody, the faster we can get into the questions. I want to welcome everybody here, and hopefully everybody is not too exhausted from these wonderful days and meetings we've had. Let me introduce everybody. I think everybody knows everybody. We're in a different order than I had, but to my immediate left is Joachim Levy, who's the Minister of Finance from the country of Brazil. To Joachim's left is Kuroda-san, Hirohiko Kuroda, who is the Governor of the Bank of Japan. Then we have Benoit Cœuré, member of the Executive Board of the ECB, and I'm sure he'll have a lot to talk about today. Mark Carney, the Governor of Bank of England and the Chair of the Financial Stability Board. And to Mark's far left is Min Zhu, who's the Deputy Managing Director of the IMF, who's making sure we are doing what we say we all do and making sure we have an organized world. So I wanted to set the tone and talk about the world. And as I was reflecting on it, I was reflecting on this exact meeting last year. So last year, as smart as we all were, we never talked about oil. It was going to go down from 100 to below 50. I don't think we ever heard of the word ISIS. We didn't certainly talk about the Ukraine and Crimea. We were confident the Federal Reserve was beginning to tighten. And I would say the overall tone of the committee, of the group, and also the mood at Davos was that Europe was healing very rapidly. And so, everyone, I hope we're going to be a little better this time. And I would say coming into this session, it is my observation, there's quite a bit more pessimism throughout the whole session this time from last year. So, as I said, last year we came away very positive. I think in some cases that was probably true, but in many cases, obviously, it wasn't so. So, with that set up, and we're going to go and talk about the world today, but I also want to bring up the world with technology and how we navigate that as finance ministers, as governors of central banks, and as the IMF thinks about it. But before we do that, let's go talk about some of the most pressing issues of the world today and the events of this week. So Benoit, let me start with you. You had a busy week.
That can lift the growth rate of Europe in a lasting way. That's about productivity. That's about having the right business environment. That's about having people want to invest. We can make it cheaper to invest, but people have to want to invest. And that is really the role of finance minister. That is the role of government. So we all have a job to do.
Was currency a component of the deliberation, and was there a view where currency would ultimately go then?
The currency?
Yeah.
It's part of the channels. It's probably not the most important channel. Mm-hmm. We don't have targets, as you know very well. We don't have numbers. The currency adjusts on markets. It floats. It's freely floating. It adjusts as a result of monetary policy decisions. So it's part of the transmission. It's not the main consideration.
So, Mark, I want to go to you first, and I may come back to Benoit. As the chairman of the Financial Stability Board, quantitative easing creates in some markets, some distortions. You see very low interest rates as a result of these purchases, large-scale purchases by central banks. You have, depending on the maturities of these purchases, you have a flattening of the yield curve. And you have behavior changes in the marketplace. And I'm sure those behavior changes are anticipated, but those behavior changes will probably lead to more movement towards higher yielding, less liquid instruments, And what we've witnessed in the United States and we've seen now in Japan, it moves huge volumes of money into the equity markets. There are some governors in the world have talked about bubbles or things, and I don't know if these are unanticipated, but you spend a great deal of time focusing on macro-prudential risk. And so how do you navigate the issue of making sure that the economies meet their targets, meet their